Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham. This is episode 24. And on today's episode, we're going to talk about the new infrastructure bill, what companies that's going to impact specifically, and hopefully give you a couple ideas for your portfolio that you might want to think about as that infrastructure bill takes shape over the next 10 years. We're also going to talk about stock screeners, what all the numbers mean, how to interpret that. And then we're really going to start getting detailed this week. We're going to go over financial statement analysis. We're going to talk about the balance sheet. What are the numbers you need to look for? What are the numbers you need to pay attention to? And really start trying to teach you how you can do analysis on your own. So without further ado, let's get started.
Wait, Dad. You forgot the theme music.
Oh, yeah, right.
You dropped this.
All right. Well, welcome back once again. After a week off, we are back. I appreciate you joining us today. So one of the big things the market is discussing right now is this new infrastructure bill. It's going to be take place over 10 years. And so I wanted to kind of show you some of the companies that's going to impact. But I had a couple people that have reached out to me over the past couple of weeks saying, hey, I'm a beginner. I really just want to know how to read one of these stock screeners. And so I thought I would just take a little bit of time here and show you kind of how to read just the main summary page of a lot of these, the websites that you go to. So I'm currently looking at yahoofinance.com, or finance.yahoo.com is the actual website. And I have Amazon pulled up. And of course, at the very top, on the top left, it's going to give you the price of the stock, which right now is $35.25. And below that, you're going to have a summary. There's all these headings. There's a previous close, which means what did it close at yesterday? What's the open? You'll see the bid and the ask price. This is, what's somebody willing to sell it for versus what somebody's willing to buy it for. Now, on something like Amazon, they're generally going to be very, very close because there's a lot of buyers and sellers that are willing to move the stock. You'll get the days range, which is, what's the range been today? You'll get the 52-week range, which is over the past 52 weeks, what's the highest it's been and what's the lowest it's been. And then we come down to volume and average volume. These two are very important. So volume is the number of shares that trade in a given day. And then for that day. And then average volume is what is the average per day that this stock normally trades. And so it's important to keep this in mind because if you have a day where, let's say, the stock drops a lot, but it's below average volume, there hasn't been a lot of volume traded, then maybe you don't need to really pay attention to it that much. This is what technical analysis would be. And then if you have a day where it goes up a lot and it goes up on massive volume, much higher than average volume, that could be a very good indication that this is something you want to pay attention to. And then you have market cap, which market cap is short for market capitalization, which is what is the value of the entire company. So if you wanted to buy Amazon, if you wanted to buy the entire company, right now it's worth $1.788 trillion. So that's the market cap. And that is found by taking the number of shares that trade for Amazon and timesing it by the current market price. Beta. And you'll notice on Yahoo it says 5-year monthly. So beta is an indicator of the stock's volatility, and this is where things get a little bit more complicated. But the stock market has a beta of 1, and so if you have a number that's higher than 1, which for example Amazon is 1.11, then if the stock market went up 1%, you would expect Amazon to go up 1.11%. And so you'll have stocks that have high betas or maybe a low beta. If you were to look at an AT&T or Verizon, for example, their beta is going to be closer to 0.5. So you would expect that if the market went up 10%, they would go up half that. They'd go up 5%. And so it's really looking at, how volatile is your stock going to be? The lower the beta, the lower the volatility should be. Now, it's not a hard and fast rule, but that's generally how it should work. So the lower the beta, the less volatility. The higher the beta, the more wild swings you could possibly get by owning that stock. And so if you own a stock that has a higher beta, it should outperform for you, because if it doesn't, you're not getting compensated for the amount of risk that you're taking. So that is definitely something that you're going to want to start studying and start to look at. You'll see the PE ratio, which is price over earnings. Now on Yahoo, it has you'll see TTM. TTM stands for trailing 12 months. So that's the PE ratio for the last 12 months. Some websites have a forward PE ratio. So the PE ratio is price over earnings, right? The price of the stock divided by the earnings gives you the PE ratio. Now, there is a lot of debate on the PE ratio. There's a lot of stuff you can go read. I will tell you that the PE ratio has been one of my best friends when it comes to looking at stocks and analyzing stocks. And generally, the lower the PE ratio, the better, because you're getting a better value for that stock. So, for example, if you had a stock that was at $10 and it had earnings per share of $5, it would have a PE ratio of 2. And so that would be considered extremely, extremely low. If normally under 10 would be extremely low. And so companies that are fast growers, they are normally going to have higher PE ratios. Okay, but once PE ratios start getting too high, it can be a sign that, okay, maybe this stock is peaked. Maybe there's too many people in the stock. Because as the price of the stock goes up, if their earnings stay the same, then that PE ratio is going to get higher and higher, meaning that there's more people in the stock, but their earnings really aren't keeping up. And so the hard part about the PE ratio, when you look at it on a screen, like right now, the PE ratio of Amazon is 68.99. The hard part of that is there's no context to that number if you haven't been, following the stock for a long period of time. So when you see something like that, you really got to go look back and kind of look at the history of Amazon and see what its historical PE ratio has been, and has that gotten better. So one of the ones I like to look at is Google. So if I type Google in here, I'll see that their PE ratio is 28.65. Now, I know that Google's PE ratio 5 years ago was pretty close to the same amount. However, in 2017, Google was trading for $820 a share. So the fact that it had a PE ratio of close to 30 in 2017 at $820 a share, and it's currently trading at $29.73, and it still has a PE ratio of 29.30, means that their earnings have kept up with the stock price, which is a very, very important indicator. So it's going to be something that you're going to want to study. Below PE ratio, you're going to see EPS, which stands for earnings per share. How much does the company earn for, each share of stock that it has? For example, if we go back to Amazon, it has $51 of earnings per share. And then you'll get an earnings date. You'll see below that, it'll have a forward dividend and yield if a company pays a dividend. Now, right now, Amazon does not currently pay a dividend. But if I were to go look at, let's see, I'll look up Johnson & Johnson since they were in the news this week. We can talk about that in a bit. But if I look up Johnson & Johnson, you're going to see that their forward dividend is 4.24%, which if you bought it at this current price would be a yield of 2.57. And then below that, it'll give you the ex-dividend date, which is the next time they're going to pay that dividend, which Johnson & Johnson's is coming up. That's November 22nd. And then below that, you'll see the 1-year target estimate, which is an average of all the analysts that are currently following the stock, what they think the value of the stock will be within the next year. So that's how you read the stock screener. And in that, this is just the first page summary. There's a lot of information in there to digest, but you really got to start learning kind of the language, right? When you're on this financial journey, you got to start being able to understand what all these things mean and kind of what's going into them. It's funny. I started this podcast because I felt like there was a lot of misinformation out there about investing, and having this increased presence on Instagram has just magnified that for me because I see all these places that people are following and all these sites, and everything's just so surface level, and it doesn't really have any meaning behind it. All these NFT tokens, a lot of these cryptos. There was an article that came out. There was that Squid Game token that came out. It ran up to about $30 or $40 million, and then in the span of a couple hours, it went to zero. And so there's really a lack of, depth as far as these financial conversations are concerned. And so I'm hoping, even though I know some of these are going to be boring, I know some are going to be more entertaining, some of them are going to be boring. I hope that you're able to go back and listen to some of these and really just be able to better absorb some of these concepts, because at the end of the day, a lot of these things that are surface level are not going to be around. You really have to think about where the value of these things come from. There was another report of another crypto that had only been out 2 weeks and the value's already $27 billion. Like, how's that possible? There's nothing there. It's just a mirage. And so you got to be careful. I had a conversation the other day that, when you're on Instagram and you're in that world, nobody really knows what they look like without filters, and everybody asks you, are you making money? Are you doing these things? Do you have a good job? All this stuff. And nobody ever just asks somebody if they're happy, right? And so you got to ask yourself, are you happy doing what you're doing? Are you happy with your investments and the progress that you're making? And it's a race against yourself, right? Like last week, I ran the New York City Marathon for the second time. It was wonderful. I put that stuff up on my Instagram. I wanted to run it again because my first time was so bad. My first time was not good. I kind of got sick in the middle of it, and I didn't remember it at all. And so, I wanted a second chance at it. But my point is that when you look at everything and all the surface level stuff that's going on with social media, you really have to make a concentrated effort to run your own race. Like, you really have to think about, if you think about the race of life, you got to run your own race, have your own experiences. You can't just watch people who are renting fancy cars and renting all this stuff and think that's the life I want. But that's what people see. And so what ends up happening is you try to obtain this stuff, and then you do, and you go, oh, well, that wasn't as good as I thought it was going to be. No, because it doesn't have any substance to it. And so I feel like I'm helping people fight the good fight by having real portfolios and saying, okay, I don't understand NFTs or cryptos or whatever. What's something I can understand so that I can build something that's going to be sustainable and not a house of cards? And that's really what this is about, is how do you build something that's going to be sustainable and isn't going to falter on you? So with that being said, boy, that's a good segue. I didn't even think about that. Like, I'm just kind of going off the fly here like I always do, but we're going to start talking about this infrastructure bill, and I'll talk to you about some of my stocks in focus that I want you to think about. But this infrastructure bill, obviously, there's a lot of stuff that's going to go into it. There's a lot of places that this money is going to go. And so you got to start paying attention, because if this does get passed, which it looks like it's going to, you're talking about 10 years of government funding into the nation's infrastructure. And so as we go, we have to start thinking about, okay, if this goes through, who is this going to impact, right? What are the companies that this is going to impact? And namely, some of them are kind of easy. Obviously, Caterpillar is the one that most people think about when they think about this infrastructure bill and who it's going to impact. But I'm hoping to share with you a couple that might not be so might not be so obvious. One of those is United Rentals. Let me type them in here. And their symbol is URI. So United Rentals is a company that allows you to be able to rent heavy equipment, other types of equipment to do jobs. And the reason that I like this one Their PE ratio is good. It's at 23, which is lower than the overall market. They have good earnings per share, but all the things that are happening with the infrastructure, or not the infrastructure, but with the supply chain, right? There's people waiting on equipment. There's, let's say you wanted to buy something from Caterpillar. It might take you 6 months to a year. I mean, you got to get in line behind everybody else. So there's going to be a lot of companies that are going to be trying to do infrastructure work that might need to rent equipment for just a little bit of, a little period of time. And United Rentals, is going to be there to help offset some of that demand. And so if you go look them up, if you go look at their logo and stuff, I guarantee you've seen it. You just probably didn't even realize, who this was. Their market cap is $27 billion. So the money that they're using for this infrastructure bill could really impact that kind of that size of a company. For example, the market cap of Caterpillar is $113 billion, right? So United Rentals is a much smaller company, meaning that those dollars flowing to it from the infrastructure bill could have a big time impact. The other one that I wanted to point out is called Nucor. Nucor is based in one of the Carolinas, I believe. Yeah, Charlotte, North Carolina. And they're a steel company. And their PE ratio is 6.77 to be exact. They're a $32 billion company. And this one is probably the one that I'm zoning in the most on. So they are a steel manufacturer, historically not a great business, a lot of competition from overseas, but with their steel mills, their steel products, they have raw materials, all these things that are going to help build out these roads and bridges. You're talking about a $1.2 trillion infrastructure bill, and this company being worth $32 billion. There's going to be a lot of steel needed for roads, guardrails, rebar that goes into concrete for bridges, and just all this stuff. And this company, it's $112 a share right now, but with a PE ratio of 6, I'm telling you, I'm all over this one. I think this one could be very, very good. There's a lot of other companies out there, aggregate companies that do materials and things of that nature, but the financials of Nucor look a lot better. And so when you look at these companies, when you're analyzing something that you want to invest in, remember, if you're an investor, that means that you're willing to hold the company for more than 2 years. A trader is somebody who holds it less than that. So if you're really wanting to invest in this over the next, 2 to 10 years, as this infrastructure bill plays out, this could be something that's going to be, very much impacted for not just the next year, but for many years to come based on this. So this one looks pretty good. So, but my point is you got to go in and you got to look at the financials of these companies and see what things look like. So the 3 financial statements that, you've probably known about or don't know about is the income statement, the balance sheet, and the statement of cash flows. And so, most people, most investors are never, I shouldn't say most investors, but I don't know, most people are not going to go look at the financials of a company. They're just not going to do it. We say, okay, this company looks good, I'm going to invest in it. It's amazing to me how many people will put their money into something and they never even look at the financials and think, oh, if something happens, bad, is this company going to be able to make it through? We don't do that. Most humans are not going to do that. But I'm going to teach you some of the things to look for when you start looking at these. And I know this is going to get really granular, and I apologize for that, but I know that there's there's a lot of people listening that are wanting stuff that's more detailed. And so I'm going to do my best to do that in an audio format, even though it's not the easiest. All right, so I'm going to give you some gold here. One of the best books I've ever had or ever read on financial statement analysis is a book called Warren Buffett and the Interpretation of Financial Statements. And this is by David Clark and Mary Buffett. And, maybe we'll do some social media stuff on it. But it's pretty incredible. It's only 227 pages long, but it really talks about how Warren Buffett goes over financial statements. I think there's even YouTube videos you can watch that show you basically 3 hours of going through the book. But it is a really, really good book for looking, of what you need to look for in financial statements. And so today we're going to talk about the balance sheet, and we'll do the balance sheet of Nucor since I brought that up. But when you look at the balance sheet, you're looking at assets, liabilities, and a lot of times somebody will do kind of a surface level check and they'll say, okay, this company, okay, what are their assets? Okay, they have more assets than liabilities. Okay, they're good. Because what you're trying to check for is you want to make sure that the company's not going to go bankrupt, right? So if the company has more assets than liabilities, then the chances of them going bankrupt would be impossible, basically, or pretty close to it. I guess nothing's ever impossible. But what you want to look for here, so as I'm looking at the balance sheet on Yahoo Finance for Nucor, you look at the assets, and so when you first bring it up, it just tells you total assets $20 billion, total liabilities $8.8 billion, and so you go, okay, they'd be good, but you can use these little drop down arrows, and that's what you need to do. You'll see current assets for Nucor. You'll see cash and cash equivalents, and cash equivalents, and what's this last one? Oh yeah, short-term investments. So this is things that they could turn into cash, and you'll see it's at $3 billion. And then you'll see they have receivables of $2.3 billion, which is money that's owed to them that they're waiting to collect. And then you'll see total non-current assets. And here you'll see one that says net PPE. So PPE stands for property, plant, and equipment. And one of the things you have to understand here is this is 6.9 billion, let's say, of property, plant, and equipment. And if something were to happen to them, could they sell all their equipment for this price? Now, for most companies, the answer to that is going to be no. Right? If they had to fire sell all of this and really get rid of it, they're not going to be able to sell it for 6.9 billion. They're going to have to discount that to try to get rid of it. This is why, like with oil companies, for example, you really have to discount their property, plant, and equipment, because in the oil business, if it's bad for one company, it's bad for a lot of companies, right? So everybody's having a garage sale and we're all selling the same ugly couch and there's nobody to buy it. If it's a retailer, this would be the inventory number, but would be what you want to concentrate on, right? So even with Nucor, they have inventory of $3.5 billion, which is steel and stuff they're looking to sell, right? But if it's a retailer, their inventory is going to be very important. If you see that inventory going up, that number going up a lot, well, that means that they're going to have to discount at some point. They're going to have to discount that stuff and send it to the clearance rack, right? So depending on the type of company that you're looking for, or you're looking at, the type of company you're looking at, these numbers are going to be more important for some companies versus others. And that's what you got to take into consideration. You have goodwill and other intangibles, which is, a spot you got to be careful of. That could be branding. That could be things that are proprietary to the company. And then you start looking at, total liabilities, which for Nucor, 8.9 billion, let's say. And so you look at current liabilities, which are things that are going to be due in the next year, and that's 2.6 billion. You have payables, current debt, and then you have long-term debt of 5.2 billion. And so when you look at this, depending on how conservative you want to be, you really have to look at, okay, how do I want to discount this? And so if you want to discount that property, plant, and equipment, if you want to be super conservative, you could say, okay, that's 6.7 billion of property, plant, and equipment. Let's say they only get 50 cents on the dollar on that. So you would discount that to 3.4 or whatever it is, and then start looking at what their assets are. And so when you look at that, when you discount this, Nucor seems to be in pretty good financial shape, even if you're discounting the property, plant, and equipment and looking at that. So, but you got to pay attention to, the debt that they have. You have to pay attention to the liabilities of companies, because just like in your personal life, if you have a lot of debt, you are promising your future income to that debt. Well, it's the same thing for a company. If a company has a lot of debt, they're promising their future income, their future revenue, their sales to servicing that debt. And if their debt gets out of control and their sales drop, all of a sudden they get into trouble because they don't have enough money to cover that. So this is really detailed for a podcast setting, but it is something that, you got to have an introduction to, and you got to put in some time on to really start learning about it. And that's why I recommended that book, because it can really help you. And so the easiest thing for me when I was learning this stuff was to pick a company that is doing well, like somebody like Apple, and really start looking at their financials and understanding what makes them a good company based on their financials, and then using that as a blueprint when you start studying other companies. And when you do that, it just starts building that knowledge base. And, I said it in episode number 1, but this really is a financial journey, and it's not done overnight. You got to be willing to put in the work, and you wouldn't be listening to this if you weren't. So I appreciate you doing that. And, send me your questions when you start reviewing the balance sheet. If you have questions, if you have stuff that you're wanting to know about, you can get a lot more detail. That's why I gave that book out, because it does go into a ton of detail on how Warren Buffett analyzes financial statements. But I'm just trying to give you a little sliver, a little slice of some of the key things that you're going to want to start looking for and noticing to make sure that you're making investments in sound companies and you're not just, betting, if you will. Because there is a difference between really kind of knowing what you're doing and just throwing caution to the wind and hoping for the best. So I appreciate your time this week. I appreciate the questions that you've sent in. I appreciate your support and all the shares. We're actually getting a lot more listeners than I thought. I guess I'm not so good at going to the websites and finding out how many people are listening. So I appreciate your shares. Appreciate all the questions that you've sent in. I hope you have a great week, productive week. Don't mistake activity for achievement. And as always, I'll see you next time.